I am here with Sean DeAngelo from Prosperity Home Mortgage. We wanted to follow up on our video last week about the buyer's advantage that Prosperity runs, and just discussing what the do's and don'ts are and when you're making a loan application. And Sean's going to explain that a little bit better and may use a little different terminology to my introduction. I'll hand it over to you, Sean. There you go.
Thanks, Nick. Good afternoon, everybody. So there's certain behaviors, we call them buyer behaviors, that can make a loan experience more enjoyable, kind of the do's that Nick was speaking on. And there's other behaviors which, if the buyer ends up, or borrower, as we kind of look at it in the mortgage world, if they go down that path, it's definitely going to be a little bit more negative an experience, and oftentimes some of them can actually impact loan approval. Where if you do too many or certain one of these negative behaviors, you could actually get denied. So obviously we're going to start with the good. As far as communication, right? When a loan officer or a mortgage consultant is asking you questions, you have to realize they're doing it on your behalf. They want you to get approved. So if you ever have questions, if you ever don't know something, the biggest thing is communication. Call, text, or email. You want to have that communication. You don't want things to come up down the road that you could have addressed in the beginning. And that kind of goes to the preparation, right? This is before you're making offers. That's a good time to have the bulk of this communication. Have a setup phone call before you actually get the application link or before you start providing documents. Have a very candid conversation where you can get on the same page. You can ask what you think might be a stupid question, but if you've never bought a house before, are there stupid questions? No, you don't know. So that's one of the things that I always like to do, is just have a very candid phone conversation up front and try to get on the same page, try to figure out what a best case scenario looks like for that buyer. That's our end goal. And then we try to work backwards from that. And then you move into documentation, right? So then once you get to that point, when they ask for documentation, you want to provide everything in its entirety. You know, the pesky bank statement one I always get. I'll get snippets, or the first 2 pages of they'll say page 1 through 5, and I'll get page 1 and 2 of 5. You know, because of those last couple of pages, it's all the small print, or sometimes bank statements, they just straight up have a blank last page. We still need all that, right? So if they're asking for documentation to make your experience more enjoyable, so you're not going back to the same website and pulling the same documents more than once, just provide it in its entirety. That's a big one, because documentation is really the way that we validate all of the information that's in your file. When you go through your loan application, all of that information needs to be verified. And the bulk of how that's done is full documentation, and we compare the two. So that's more of like a housekeeping kind of item. As far as what you're doing in your day-to-day life, the most obvious one is whatever housing payments you currently have, you want to continue to make your payments. And that's clearly and obviously the big one, right? Continue to make mortgage payments, continue to make rental payments. But on top of that, all of your payments. I mean, yes, the housing payments carry more weight if you miss them, or you're tagged as being 30 days late on either rent or mortgage, because there is rental verification as well. But all of your bills, right? I mean, you want to make sure that when we do eventually pull your credit, we don't want to see late payments. It's, you know, with housing late payments, that can kill a file. You miss a payment on a credit card, you know, that won't necessarily kill a file, but it'll kill your credit score. It's not going to be great when you go back in and see a 30-day late on there, and you thought you had a 750 and now it's down to a 680. I mean, one 30-day late can have a pretty substantial drop in score. So continue to make those payments, right? Especially housing payments, because obviously the mortgage payment, that is a housing payment, right? We're going to look at that a little bit more strictly than we would say a auto or student loan or credit card missed payment, right? And as we're talking about credit, we should probably get into that a little bit as well. Don't make big credit changes. No new credit, right? Just continue on the credit path and your day-to-day as you normally would. Don't make any big changes. and less instructed to, right? Which we can make another video about that as far as trying to improve credit score, because that is kind of a broad topic. But in the sense of just keeping things the way they are, no major changes as you're moving through loan application, how do I want to say this? Keep your normal behavior the same, right? Just kind of keep what you're normally doing going. Same thing with employment, right? If you're thinking about switching jobs, or you get an offer for a new job midstream, it is possible to switch. We can switch employers, but you want to make sure you give yourself enough time. In most cases, if you're going to be switching employment and there's no offer letter, it's just like, hey, this company offered me a new position and I'm going to take it. You need to give yourself enough time to leave the one company, start at the next company, and then hopefully start showing us some pay stubs to prove that you've moved to another company. But normally, you don't want to be switching employment as you're also applying for a mortgage, because it can create issues. What happens if the settlement date that you choose from a listing or from the seller doesn't mesh with what your new start date's going to be at the new position? You basically just lose the house of your dreams because it didn't fit with the timing of your new position. So if you can, best case scenario, don't be shopping for a new job while you're also shopping for a house, right? It's not normally going to work out in your favor, but it can. And those are the big ones, right? Outside of potential problems that can come up and how do we address them, a lot of that falls into the communication bucket, so to speak. If you do have credit issues and your normal behavior on credit payments is creating those credit issues, then yes, you don't want to continue those credit patterns, because if you're missing your payments, that's not good, right? So the assumption behind that is, yes, I'm making my payments on time and I'm going to continue to do that. All right, so that's all pretty basic stuff, right? The real list that we want to talk about is the don'ts, so to speak, the negative buyer behaviors that, again, it's either going to create a negative experience for you, you're going to create more work for yourself, or it will lead to a denial, which you may have started off good midway through the stream. Depending on which one of these we go over, it can kill a file. And I guess we can kind of start off with the employment because we just talked about it, but changing your employment midway through, right? That's something that it can be fixed, but a very specific set of circumstances need to happen. We normally need to see a pay stub. Are you going to get that pay stub before you settle? Is there enough time to make that happen? Making major purchases, to kind of shift gears here a little bit. So that goes back to the no new debt. Especially racking up credit card debt. Sometimes you'll see people get new cars, which is that one always really surprises me because it's a hard inquiry on your credit report. Plus, it's one of the larger monthly payments that we normally see get added to your monthly debt to income figure. So that's definitely one that always kind of shocks me when somebody buys a car midway through. The more common one that we see is folks will be saving up for down payment. So they start stacking bills on credit cards. You want to try to avoid that the best you can. Honestly, that comes up to the communication part in the beginning. When you're talking with your mortgage consultant, you should have that. If it's going to be tight for overall assets, you need to have the conversation of, all right, if I don't have enough assets now to cover, but I'm telling the mortgage consultant that I'll have them by the end, by final approval, you need to lay that out. Maybe run an expense report. What do I net from work? What are my expenses? No going out to dinner, save money. You need to figure that out and not stack more debt on a credit card, because there's another soft credit pull right before closing. They're going to see that increase. Another common one that we see a lot of time is folks get excited. They start buying furniture and appliances on credit to fill up the house because, sellers taking all their stuff. Sometimes the seller will leave their stuff there. That's cool. But a lot of times they take it with them, right? So wait till after. If you're gonna stack that debt on there and you don't have the actual, liquid assets to pay for the stuff cash, don't do it before closing. I mean, it's going to be another hard inquiry on your report. It's going to be another monthly payment that gets added to debt to income. If you push those monthly payments too high, that is something that will commonly kill a loan. And at that point in the loan, you may have already paid for home inspection. You may have already paid for appraisal. You're not getting those funds back. Once you pay for those services, inspectors go out. Once they inspect the property, you just paid for services rendered. You're not going to get a refund, right? So you want to make sure that you kind of just stay the course, right? Another big one, making large cash deposits. Cash is not king in the mortgage world. It will sometimes be referred to how much cash do I need to close, but they don't actually mean green dollars being deposited into a bank account. They're just using cash as another term for total funds available. If you cannot source where the money came from in a bank account, we cannot use it for settlement. It has to be sourced from something. That means, let's say you're receiving gifts from a family member, wire transfer. Let's say it's wire transfer and bank statements from the donor, not to mention bank statements from you showing it came to your account. If they give it to you by check, front and back images of the check, possibly a deposit slip to show like when it went in so we can track it. More on the gift, right? Let's say they're dissolving financial investments or a retirement account for them. Parents have the $500,000 in investments. They want to give $100,000 to their child for down payment. Totally acceptable, but they're going to need to show, the mutual funds, the money market accounts, the IRA, they're going to need to show what's being dissolved, the path through the bank accounts to the buyer's bank account. Cash, where's cash coming from? You got your Uncle Johnny who doesn't believe in banks. He's got 30 grand in a shoebox under the bed. We're not going to be able to use that, right? So don't depend on that. Again, communication up front. Cash will not be used, right? So, and that's another one that's just an example of cash for down payment and closing costs. I had a file not too long ago where somebody was depositing cash into a bank account to then pay down debt in order to qualify. You can pay down debt in order to qualify. You still need to show where the funds came from. So that's the reason I say no large cash deposits is because it's about sourcing the funds and finding where the funds are coming from. So again, that's another conversation that you have with your mortgage consultant up front when you're talking about, hey, I have enough money to close. If they ask you where the money's coming from, it's not because they're trying to kill your loan, because they're going to need to figure it out later. It could collapse the loan later, so they need to know that. Now, the next, I was going to go into transferring money, but I feel like we kind of just covered a lot of that. So I'm going to skip over to closing credit accounts. It seems like you're doing the right thing, but make sure that if you are going to be closing credit accounts, that you've had some kind of simulation done. We use Credit Plus as our vendor, and they have a payoff simulator that we can run for folks. But don't think that you know what the best account is to close over others. For the most part, if you close out an account, oftentimes it drops your score. Now, paying stuff down and keeping it open, that's one thing. That's mainly credit cards, right? You're paying down your overall balance, but you keep the account open so you maintain the credit history. Closing off accounts, like if you have a credit card, you've had it open for 20 years and then you pay it off, you just lost 20 years worth of credit history on that line. Once it's closed, the credit history doesn't transfer over, the account's closed. So that's why I say that. There are some instances where, maybe you had a collection account and it's one of the credit items that's only been open for a couple of years, but you have 5 other accounts that have all been open for 10 years. Yeah, you could probably close that one because it's not going to bring your overall average down. But for the most part, if you do need to close a credit account, make sure that you're at least speaking with the mortgage consultant, and if they have the ability to run it through a simulator to make sure that it's actually going to be a net gain, right? That kind of goes into.
I didn't realize you could do that you had simulators. I didn't realize you had simulators that you could do that with. That's very useful.
It is. We have to have a credit pool up front, and the only thing it's simulating, just to be clear on that, is a payoff situation. If you I call it actionable items. Like if you have like a collection account or credit cards with the balances are almost at the max limit, they're using up most of their credit. Those are the best I shouldn't say the best, the most applicable scenario that you would use for the payoff. It's essentially a payoff simulator.
Right.
Asking questions like, if I dispute this, or if I open up a secure credit card, how long will it take for my score to improve? It can't simulate that. It doesn't go that deep. But for payoff, I'd call it a payoff simulator. That may be a
Right.
better way to put it. But it has been effective. Essentially what they do is they take your current credit report, we send them in 2 target scores, and they then tell us, okay, based off your target scores, you need to pay off this, this, and this, and give it X amount of months and re-pull it, and then your score should be here. A little bit deeper of a conversation on that, but it's available. You know what? We should talk about this other one too, now that we're thinking about this. Consolidating your debts into 1 or 2 credit cards. This kind of goes back to closing the accounts, where oftentimes folks think that they're improving it. Like, oh, well, my balance is so high on this. My balance is so high on this. Why don't I just get another loan and pay it all off? There's a lot going on with that when you think about consolidating debt. You're not actually, just because you're taking one of the balances off of one card and then transferring them to the other, it doesn't mean that the overall ratio has gone down. You just move the debt from one card to the other. Not only that, if you're opening a new card to push money into, to consolidate your debt into, you've now just opened a new account midway through. That's another hard credit pull. And you just brought down your overall credit history. So that's normally not the best way to go to start consolidating debt. I definitely don't recommend it. Applying for new credit cards, I'm kind of beating that to death here. So no new debt. If you are going to be paying off loans, credit cards, charge off, collection accounts, again, communicate that with the mortgage consultant just to see, is that a good idea or not? Just don't start doing it, because you may not really know. Like, you may think you know, but you may not actually know what the credit rules are and how it's scored. Financing any kind of medical procedures, especially elective medical procedures. Again, that's just another new debt, but it is something that we run into from time to time. If it's imperative, that's one thing. I mean, your health comes first. Maybe you put buying a house on hold, but elective stuff, I mean, you're choosing to do it, right? Again, it's another new debt that can wait till after you purchase the home. And I guess just in general, making sure that you're keeping track of not getting your credit pulled, maintaining good credit habits. And then I know this last one is going to seem really basic, but making sure that you're keeping track of the account and the overall assets, because we don't ask for updated assets on a daily basis. So just make sure that you're checking that savings account and that checking account every so often, so you don't overdraw. That's something where it seems like such a simple one. Don't spend the money that you said you were going to have for closing, but people get busy, and it does happen more frequently than you would think. And we can't check in on somebody every day to make sure that they're not spending it, right? That would be crazy for us to ask for transaction histories every day. But as you start the process, if you, as the buyer or the borrower, again, in our terminology in the mortgage world, if you are that tight on assets to close, again, have that conversation with your mortgage consultant and say, hey, this is what I net every month. These are my expenses. This is what I think I can save every month. Or maybe you're paycheck to paycheck and you're receiving gifts and you already have, like, if it's that tight, then they really should be checking every day or every other day to make sure that they're staying on track, because it's not a short process. I mean, it'll take 30 days, 45 days for us to close. So that's 30 to 45 days of them hopefully staying on top of it. And I know that last one seems really kind of basic, but you'd be surprised. There's a lot of stuff going on, as you know, Nick, just on the realtor side of, making sure that the inspections are scheduled, is the sell side doing what they said they were going to do, communicating with us on the lending side. That's a lot. It's almost like a part-time job for the buyer for that, say, 2-month period of them shopping for a house, going under contract, getting the financing set up, going through the home inspection, the appraisal. If there is negotiations that are still happening between you and the sell side still, There's a lot for them to be managing on top of their actual life. So you'd be surprised. Sometimes stuff falls through the cracks, you know?
Right. Okay.
Yeah, but those are the big ones. I would say those are the big ones.
Sounds good. Thank you. And we'll come back and revisit some of the other things that we mentioned.
Yeah, absolutely. Thank you for having me.
All righty. Thanks. Have a good weekend.
Yep, you too. Bye, Nick.